Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the first quarter of 2015. My name is Nick Basso, and I am one of the portfolio administrators in Ironwood's investment division. Tonight it is my pleasure to introduce our featured presenter, the Chief Investment Officer at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also served as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type them into the questions box on the GoToWebinar panel at the side of your screen. We will do our best to address all of the questions at the end of the presentation. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean, take it away.
Thanks, Nick. Good evening, everyone, and welcome to another edition of the Ironwood Quarterly Insight. I'd like to take the time to thank everybody. I know everybody's schedule is busy, so to carve out an hour to listen to some fun economics and market talk is great. We'll try and keep this as exciting as possible. Hopefully we can keep it as exciting as last Sunday's Super Bowl game. But I doubt we're going to be able to hang with the Super Bowl because that was an exciting game. But I'll try. I'll try my best. So let's make sure the attorneys get the credit they deserve. Topics to cover. So if you're new to this format, I try and keep it very similar, very fact-based. So we're going to go over a look back at 2014 and really what we kind of coined as the year of the greenback, and we'll discuss why we're coining it that way later in the presentation. We're also going to talk about what we see for 2015, and then wrap it up with how does it all affect our investment strategy and our portfolio. So I'd like to kind of start off the last few webinars. I started off with this slide here just to kind of show where we've come from when we listen to the media and read newspapers and magazines and see that the S&P is at all-time highs, and you kind of lose the perspective of where we've come. And it was only 5 or 6 years ago that when we were meeting with clients were very, very concerned with the stock market, with the economy, because we had just gone through the financial crisis, one of the worst recessions in U.S. history and in global history, and it was very difficult to do the right thing at that time. And so I'd like to start off with this slide to kind of show us where we've come and where we are, and then in retrospect kind of compare it to a couple of other values here, in particular the last peak that we saw back in October 2007, and then the peak before that, which was March 24th, 2000. And you can see even though we've come 200% plus from the March 2009 lows, our valuation metrics still look in line, maybe slightly overvalued, but we'll talk about that a little bit more later in the presentation. But I'd say as a whole, the U.S. market is in line value-wise, and it is much more attractive than it was in March 2000 when we had PE multiples of 25 plus, when we had a dividend yield of 1.1%. This was irrational exuberance. We're not to that point, but we're a lot further than we were a few years ago. And we can already see some small slivers of greed turning up in conversations. It's nothing to be worried about at this point, but we definitely want to be cognizant of it and be cautious while we're building our portfolios. So that's kind of where we've come from. This is the last 20-ish years. So just got to give you an idea of where the S&P 500 has been. And then if we look at a longer period of time, we can see that although this looks dramatic when we look at a 20-year period of time, when we look at over a 100-year period of time, we get a better perspective of kind of where we've been and where that puts us. And it doesn't look like we're way out of alignment when we look at this longer-term chart. So I'd like to bring that up as well. Valuation metrics. I touched on this slightly, but in regard to the domestic stock valuations, we're not jumping in with 2 feet at these levels when we're talking about wanting to buy domestic stocks. Valuations are not as cheap as they were, like I said. We believe caution in the domestic markets is prudent. Not to say that earnings cannot continue to increase, and the stock market could continue to go up with those earnings. It's just that these levels were definitely more cautious than we were, say, 2, 3, 4, even 5 years ago, when we saw PE multiples of 10, 11, 12. It was very difficult to get investors to want to invest at those levels because of what the market had done, but it's a lot more attractive to buy into stocks when multiples are lower than when they're at levels like we currently are. But in history, we've seen valuation metrics that swing one way and then swing way too far to the left, let's say, and then way far to the right. And we're nowhere near way too far to the right now. We're just getting close to that fairly valued. So at that point is when you really want to take a look and make sure you're looking at the long term and not chasing returns. So I wanted to just take a look at each of these valuation metrics and compare it to the 25-year average. So we've got PE multiples. Our 25-year average PE multiple, 15.6. We're at 16.2. A little high, but in this interest rate environment, you could make the argument that we should be a little bit higher than our 25-year average. So let's just say that's pretty much in line. Case-Shiller, 27.3 versus 25.3. Once again, low interest rate environment. You can make the argument that a low interest rate environment would lead to a higher PE multiple in the current environment. Dividend yield, you can see 1.9 versus 2.1, pretty close. Earnings yield, so real earnings yield. This one is actually still showing as positive. So our long-term earnings yield, and the earnings yield is the S&P 500 PE multiple flipped upside down. So you can see the earnings yield here is 6.2%, and then if we take out inflation, we get that 3.7% number, and that is looking at the S&P almost like a fixed income type of an investment. It's just a little bit different way to look at it. But if you look at real earnings yield, if it's above 2.5, you're looking at pretty positive metrics there. And that has a lot to do with the low inflation rate coupled with the earnings yield still looks pretty positive. So that's one that's kind of out of the norm. And then the price to book, 2.9 versus 2.9, cash flow 11.4, 11.3. So most of these are in alignment with long-term averages, and then a few of them, the earnings yield minus the high yield bond index, you get 1.5, which is still positive. So this is basically telling us that if you were to look at this and say, okay, well, do I want to invest in stocks or do I want to invest in bonds, this would tend to lean toward a little bit more toward stocks versus bonds. But when you look at this in aggregate, you get a fairly valued situation versus a undervalued situation. So we just want to bring that up. Just like we brought up the fact that equities were very attractive in 2009 and 2010, we're now bringing up the fact that we're a little bit more fairly valued, so we have to be a little bit more careful in the selections that we make and the risks that we take. The quarter number 4, 2014, the results that we had, the S&P 500 during the fourth quarter was up 4.9%. It had a great quarter. It finished strong. It made up for a pretty poor third quarter. International stocks, on the other hand, were not so positive. In fact, developed international was down about 3.5%, and emerging markets was down 4.4%. So that's a when you see a up 5 versus down 4, let's say, that's a 9% difference. So that's a big difference in a 1 quarter return. And so we want to make sure that we're cognizant of that. The 10-year Treasury during the quarter decreased from 2.5 basically to 2.17, and thus far in 2015, it's even dropped further. As of today, we were at 1.81% on the 10-year Treasury. So that's below 2%, and that definitely is something that we're paying a lot of attention to. We did not believe that 10-year Treasury would drop after it hit 3% a few years ago. We'll talk about that a little bit later in the presentation as well. ISM data looks very good. And then last but not least, job growth looks great right now. The last couple of jobs reports have looked fantastic. We'll get another look into that tomorrow with the January jobs number. So we'll make sure to keep an eye on that as well. This is just a few more asset classes. So you can see the top performer in 2014 was actually real estate. This just happens to be U.S. real estate. If you look at global real estate, you're looking at about half the return there, so 14, 15%. S&P was up 13.7% for the year. U.S. bonds were up 6% for the year. Small cap was up about 5% for the year. Cash was flat. Market neutral was flat. Emerging markets were down 2%. International developed was down almost 5%. And then last but not least, commodities down 17% for the year. And you can kind of see a pattern going with commodities. Second to worst performer in 2011, worst performer in 2012, worst performer in 2013, worst performer in 2014. You don't see that a lot. If you looked at any of these charts from any time frame, it's very rare that you'll see an asset class that is the worst performing asset class for 4 or 5 years in a row. Typically what happens is the worst becomes the first, and vice versa. So, that's definitely something that we're looking at. Commodities look very attractive at these levels in our estimation. But it was definitely painful to have commodities in the portfolio in 2014. A diversified portfolio, a properly diversified portfolio should have asset classes like commodities that are lowly correlated to other asset classes in the portfolio. So 2014, the U.S. economy continued to improve. In fact, it improved very, very dramatically. In fact, quarter 3 GDP growth was at 5%. The first estimate for quarter 4 was 2.6%. We just got that a few weeks ago. The year-over-year growth for GDP was 2.5%, which is just slightly better than the expansion average here. But keep in mind that the first quarter of last year was really lousy. In fact, we had a negative GDP growth in the first quarter of last year. And so you want to make sure that you keep that in mind when you're looking at the 2.5 number. It was actually a little bit better than that if you look at kind of how we ended the year versus how we started the year. Cyclical sectors, I'm not going to spend a lot of time on this slide because they're basically the same as they were last quarter and the quarter before. Cyclical sectors are showing improvement. We've got car sales improving at a great pace. We've got home sales, housing starts improving at a great pace. Real capital goods orders dropped a little bit, but you can see the overall trend is in the positive direction. And then something I just want to point out is inventories have been creeping up. They're not at huge levels, but we definitely have seen inventories creeping up, and we want to make sure we keep an eye on that, because that could slow future growth if inventories were to get too large. But in all, the cyclical sector looks very positive. Consumer finances. This has been a big drive of PE multiple expansion, of consumer confidence, which drives PE multiple expansion. You've got net worth here. If you look at the net worth over the last 3 years, we've created $15 trillion of net worth. If you look at since the financial crisis, a lot of folks are paying off debt. We have 8% less liabilities now than we did in 2009. Household debt is at very, very low levels on a historic perspective. So consumer finances look great. They're improving. I think folks still remember what happened in 2008, 2009, and they want to be a little bit more conservative. So that's why we're not, we're seeing the big time greed stuff happen, but you're definitely seeing some shoots of it. But consumers are in a lot better position than they have been in the past. This chart is it's a double-edged sword. Consumer confidence, 98.1. You can see a huge spike in 2014. There's a few reasons for that. One, employment growth has been very, very positive, and you can see one of the impacts on consumer sentiment is 1% year-over-year rise in the unemployment rate is a negative 4.4. So we lose if we have unemployment go down by 1%, which it has over about the past 5 years. It's gone down 1% per year for the last 5 years. That's going to add about 4.4 points to the consumer confidence index. The S&P 500 was up, and so that's going to add to the consumer confidence. Home prices are up. That's going to add. And then this big one that just recently happened over the past 6 months, oil has dropped over 50%. Gas prices have dropped. Before, just recently, they were down about 30 to 35%. That is a huge positive for consumer confidence. And so that's why you see this consumer confidence spike up. But that's a good thing. People feel better, and they might spend a little bit more money. But then you look at, okay, well, what's happened in history when consumer confidence has been high? Well, consumer confidence was high in January 2007, and the next 12 months return of the S&P 500 was a negative 4.2%. January 2004 was a high, and the next 12 months we went up by 4.4%. Negative 2%. We had a positive 13% in 1984. In May of 97, we had 1.2%. These are annual returns from the point of highest consumer sentiment. So most of these numbers are not great numbers for the year after, and that's that's one of the reasons that we're cautious. Is you're getting to the point where stocks aren't hugely attractive. They're not overblown, but we've got consumers getting confident. This is when greed can start to come in. We don't believe that it's happened yet, but we definitely want to be cognizant of it. Alternatively, if you look at when confidence is the lowest, you see some really good returns when everyone is not confident at all. It's because everybody that wanted to exit the market has exited the market. So in February 1975, we had a year return of the S&P of 22% after a low in the consumer sentiment index, 19 in 1980, 29 in 1990. So you get the picture here. You want to be more aggressive when everybody else is feeling lousy, and you might want to be a little bit more cautious when everybody else is feeling pretty good about themselves. And so that's one of the things that we are trying to pick up here. You know, we were very bullish down here, and it was very hard to be very bullish down here. Now we're saying, okay, let's pause, everyone, and let's look at, you know, what we're doing. And, you know, we don't want to just go in all in with equities. We need to be careful at these levels. We haven't seen a pullback of more than 10% in 3 years. So I don't want to scare anyone, but I definitely want everyone on the call to know that, hey, you know, we're looking at this and we're trying to be cautious going forward. Labor market, like I said, the unemployment rate has significantly improved. It's down. The last reading was 5.6%. Tomorrow we'll get another jobs report. At 5.6%, at 10% unemployment, you know, you expect unemployment to go down by 1% per year. At 5.6%, it really can't. You know, we can't go much lower than, you know, probably 4.5% is what the economy can handle as far as an unemployment rate. So we're running out of room on the unemployment rate. Now, one of the things that has caused that might be a little bit of a, where we can't compare it to history as much, is this labor force participation rate has also come down. Now, this is a longer-term issue. This has to do mostly with baby boomers retiring. And so you have the stock market up. You have people retiring because their assets are a lot more than they thought back in 2008. They worked a couple more years. They're that much older. You know, we have a ton of people turning 65 each day. And so you're gonna have participation rates decline because you have people leave the workforce to retire. And that's going to artificially lower the unemployment rate because your participation rate is lower. So that definitely is something that will help that unemployment rate look a little better, and maybe we can argue that maybe that unemployment rate could go to 4.5. But still, even at 4.5, we're only 1% away from that. And so you're gonna start to lose the benefit of having people be employed. Like I said here, we went from 10 to 5.6. One of the things that hasn't happened yet is wage increases. Wages have stalled, actually. If you look at this, we had a pretty good trend going in this last labor report. Wages just fell off a cliff. If the unemployment rate keeps coming down, you can see what's happened in history. This is inversely related. These two indexes are inversely related. As the unemployment rate comes down, you have less slack in the labor force, and therefore you put pressure on wages. You have to pay people more if there's not a lot of skilled workers out there, and so you see wages go up. And so we do anticipate wages going up with the unemployment rate coming down, and that is what really is missing to create some inflation. Is we're waiting for that wage growth, because that will start the economic velocity of money churning, which will start to show some signs of inflation when we start to see some wage increases. So it's not something we're seeing right now, but we definitely want to keep an eye on this wage growth. So tomorrow, one of the things I'm looking at when they come out with that number is specifically what was the wage growth. And that ties directly into this next slide, which is inflation. Headline CPI, 0.7% in December. Now that has a lot to do with energy, gas prices, and oil. But even the core CPI is at 1.6. These are very low levels. The Fed is not worried about inflation right now. So I still think they're probably going to err on the side of being easy for a little bit longer. They've already stopped quantitative easing, but we're trying to figure out, well, when's the first interest rate increase going to happen? Well, that leads to the next section here. Let's talk about interest rates. Let's talk about the Fed. Let's talk about QE. Interest rates over the last 30 years have continued to go down. That's been a definite tailwind for fixed income investments. In 2013, we saw, in the summer of 2013, we saw the very brief turnaround of rates. They popped over 3% in a very quick period of time, caught a lot of people off guard. Bonds took it on the chin. Stocks ended up taking it on the chin. Real estate did. A lot of different asset classes took it on the chin when interest rates increased very dramatically. And since then, we've had kind of a global slowdown, except for the U.S., and everywhere beside the U.S. has kind of slowed down, and so a lot of money has flowed to U.S. safety and the 10-year Treasury, and it's knocked that 10-year Treasury down below 2% again. So we believe that this is an area that just is not sustainable at below 2%. The Fed has stopped its quantitative easing, like I said before. The balance sheet of the Fed is no longer getting bigger. From the financial crisis to now, it's been increasing. And the reason we haven't seen much economic activity is because the excess reserves, or the money the banks are putting back on the Fed balance sheet, keeps getting higher as well. So this money is not being used. When the Fed goes and buys Treasury securities and puts money into the system, the banks are taking that money and then putting it right back on the Fed's balance sheet. So nothing's really happening except for the Fed's balance sheet is getting a lot bigger. And until we start to see the velocity of money pick up, it's not going to have a big economic impact. Now, it might have a psychological impact, which we believe it has. QE1, QE2, Operation Twist, QE3, all of these things help the stock market, and they continue to help the stock market. The fact that interest rates are as low as they are, between basically at 0%, we're going to start to see a change here probably in the second half of 2015. And you can see here in this chart, FOMC year-end estimates. Well, the FOMC at the year-end 2015, we're above 1% as far as an estimate. Now, the market expectations below that. So if FOMC year-end estimates are correct, the market's priced in less than that. They believe that we'll have less of an interest rate increase than what the Fed is saying in their minutes. So if we actually see what the Fed is saying, then bonds are probably not a good place to be because they're priced for a slower interest rate increase versus what the Fed is actually predicting. Credit conditions. So common equity as a percentage of total assets, these are credit conditions for banks. Common equity as a percentage of total assets at 11.1% in 2013. We haven't seen levels like that since the Great Depression. So banks are being very cautious at these levels. They have definitely learned from the financial crisis, and they are very cautious about in particular, their real estate loans. And you can see down here, real estate loans really have been declining since the financial crisis. Above this line is growing. We just barely started to get some growth in residential loans within the last year and a half, call it. The average credit score on approved mortgages is 743 versus in 2000 where it was 660, and in 2004 where it was 700. So and this is the average credit score. So that's you can see just based on this chart, it's one of the highest numbers that's been on there for the past 20 years. So banks are definitely getting more stringent on their lending. High yield bonds. The last couple of webinars, we've mentioned that we've been concerned about high yield bonds. The spread here, so high yield spreads are what is a high yield bond paying us above a treasury? And in history, high yield spreads have been about 5.9%. Right now, currently, that level is 6. In July, basically June 30th of 2014, the spreads were at 4%. So last summer they were at 4%. October 1st of last year, so just 4 months ago, spreads were at 4.4%. At that time, we were changing the portfolio and reducing our high yield exposure because we weren't getting paid. If you're getting paid 4% over a treasury, you're getting a lot less than you had been getting paid for the risk that you're taking compared to history. Well, now that the yield spread is back up to 6, now we're getting paid commensurate to the risk that's involved. So that was definitely something that we were watching last summer, and we definitely changed the portfolios around, and we're very glad that we did that, because high yield did not have a good 2014. It still made money, but close to around 2%. And so that was definitely something that we wanted to make sure that we avoided. But now it's looking a lot more attractive again, or at least in line with historical perspective. And it wasn't just in the U.S. that we've seen high yield spreads increase. We've seen it throughout the globe. You've got this upward trajectory of high yield spreads. So we're at 1.81% right now. It's going to be very hard pressed for us to go down a lot more from here. But if we did, let's just say we went down to 0.8. So we lost 1% on the 10-year Treasury. Not to say that that's probably a high likelihood, but for illustrative purposes, let's say that happens. You can see that the longer duration bonds are going to benefit more from an interest rate decrease. So the way you read this chart here is if we have a 1% decrease in the 10-year Treasury and it goes from 1.8 to 0.8, then if you hold a 30-year U.S. Treasury, the principal on that Treasury will go up by 23.2%. If, however, interest rates go from 1.8 to where they were a year ago, 2.8, probably a lot higher likelihood outcome, that same 30-year Treasury is going to lose 17.8%. And, this chart just gives us an estimation of the price impact of a 1% rise or fall in interest rates. I would probably be more concerned with the rising interest rates because that's the environment that we're in. If you have a 2-year Treasury, it's going to be a lot less impacted than a 30-year Treasury by a 1% increase. The reason? It's 2 years from you getting your money back and then being able to go and reinvest it into another bond, into a brand new bond that's paying higher than the one that you had. Same with some of these other bonds here. Floating rate, convertibles, asset-backed securities, U.S. high yield, mortgage-backed securities, they have less interest rate risk than munis or investment-grade corporates. So we've definitely positioned the bond portfolio in the manner that we're taking a little bit less interest rate risk at our current levels. Now we may be giving up a little bit in return to do that, but we're also protecting ourselves a lot more against increased in interest rates, and so that's something that we definitely are keeping an eye on. Interest rates and equities. What's the correlation between the two? When interest rates are low like they are now, an increasing interest rate up to a certain point is actually a positive thing for stocks. And it makes sense because when you're at low interest rates and you're starting the recovery and we're starting to get a little bit higher interest rates, it means the economy is doing better. And up until the level of 5%, a positive move in interest rates, so an interest rate going from 1.8 to 2.8 is actually positive for stocks. It has the same relationship, a positive relationship between yield movements and stock returns. So that's kind of where we are now. If we crossed 5% and that 10-year Treasury went above 5%, now a move in the 10-year Treasury from, let's say, 5 to 6% actually has a negative correlation to stocks. If we had a 10-year Treasury at 6%, it would be a lot easier to build some portfolios that yield a little bit better return and still keep the safety that we need in a lot of our portfolios. It'll be a refreshing day when interest rates are back up to more normal levels. International. So this was the story. I'm going to spend most of the time. I skipped through those first couple of slides fairly quickly. This is where a lot of the confusion has come this year. We have a lot of investors who are looking at their returns, seeing a lot lower returns than maybe what they had expected, and it's because most of our investors, almost all of our investors, live here in the U.S., and they're nonstop inundated with what the S&P 500 has done, what the Dow Jones has done, and what the NASDAQ has done. And those are all U.S. stock indexes. And the one that a lot of folks follow, and rightfully so, is the S&P 500. But it only tells half the story. It only tells us, it doesn't even tell half the story. It tells a very small portion of the story. The S&P was up 13.7% last year. So that's just telling us large cap U.S. companies were up, on average, if you look at the whole basket, we're up 13.7%. But that doesn't tell us what emerging markets we're doing, or international, or commodities, or real estate, or small cap, or mid cap. And so one of the things that really was a differentiator in 2014 was the fact that the dollar index completely exploded near the end of 2014. And you can see it right here. Here's 2014, bam. We just jumped off of a cliff. Or actually I should say jumped off of a trampoline. If you were in some of these other currencies, it was off a cliff, like the euro, the yen, so on and so forth. One of the reasons that we saw this huge spike is, one, the U.S. economy did a lot better than a lot of the other economies in the world. And so you have investment coming into the U.S. The second reason is you have the Federal Reserve starting to talk about interest rate increases, whereas you have the Eurozone just announcing that they are doing $60 billion billion euros per month QE program, something the U.S. started doing, a few years back, and you've got Japan doing the same thing. So you've got a divergence in monetary policy, which is going to drive these currencies. And currencies are interesting because currencies if your currency weakens, you end up becoming a lot more competitive compared to the currencies that strengthen, and that helps your economy. And when you have your currency strengthen, you become less competitive against those other currencies. So it's almost a self-correcting cycle, and that's one of the reasons that currencies float like that, and they self-correct. So one of the things that we want to look at here is what impact does that have on our international investments, the fact that the dollar increased as much as it did. So we're looking at returns here. We can say, okay, the S&P 500 in U.S. dollars, which is local, it was up 13.7%. The EFI index, or if you just want to, it's developed international index, it was up 6.4% in local currencies. But then if you translated that over to U.S. dollars, you get a negative 4.5% return. That's an 11% difference right there. And then if you look at the difference between international and domestic, you're at an 18% difference. So international stocks performed 18% worse than domestic stocks. That is one of the disconnects that happened in 2014. Emerging markets, same story. In local currencies, they're up 5.6. In U.S. dollar terms, they're up down 1.8, and you're looking at a 15% difference in the return between the two. So that makes a big difference when you own some of these international and emerging markets, and you own some different debt and commodities sprinkled in there. It's definitely going to have an impact on your portfolio. But that doesn't mean that your portfolio should consist of 100% S&P 500 large cap U.S. stocks. That is not the case, and most investors are going to be more suited to have a diversified portfolio that ends up over time taking on less risk because of the correlations not equaling 1 between asset classes, which then reduces that risk. One of the things I touched on was the differential, the global monetary policy differential, and you can see that here. Europe actually, okay, so we've got the financial crisis. Everyone eased. Japan, not so much, but Europe and the U.S., everyone eased right away. The U.S. continued to ease. Japan continued to ease. We had a Greece blow-up possible in 2011. So Europe did a couple of programs, and then they took that away, and they opted for austerity, and they stopped doing monetary policy. Europe went into a double-dip recession because of this, or that's our opinion, that it was because of the misstep that they took with monetary policy that they ended up in a double-dip recession. Well, now we've got the U.S. starting to decelerate the monetary policy, and we've got Europe starting to accelerate the global monetary policy. And then you've got Japan going crazy, trying to cause inflation because they've been in a zero interest rate environment for a very, very long time. So when you have that divergence in monetary policy, that's why you get this phenomenon here. Now, eventually, that's going to end up helping the Eurozone. It's going to end up helping Japan because their currencies are going to devalue. They already have dramatically, and that's going to make them more competitive. And then you throw in lower energy prices, and you throw in less government fiscal drag, and you can actually start to see some really good things happening internationally. And not only can you see good things happening, but you also are looking at assets that are more attractively priced. And so that's why we believe that there's a little bit better opportunity in international and emerging markets, all else equal, versus the domestic counterparts in the equity markets. Here are some market PMIs, flash PMIs. So you can see that the dark green means the economy's humming pretty well. Yellow means we're kind of just growing just a tiny bit, and red means we're slowing. You don't see a lot of red here. You see mostly green and a little yellow. And Eurozone, actually, if we were to update this through January, this is up around 51 now, and the U.S. is still right around 53, 54. But we're starting to see some better numbers out of the Eurozone, and one of the things right off the bat is they don't import a lot of, or they don't export a lot of oil. They import a lot of energy, and so that's going to be a benefit when oil prices go from 100 to 50, like they have. Also, the euro is now at 115 as of today versus 135 where it was a little while ago. So those things are all going to benefit the Eurozone. Assuming we get through the whole Greece thing that we're dealing with right now, that the Eurozone is dealing with. Another positive for Europe is their unemployment rate still at 11.5%. So as that unemployment rate comes down, as that improves, that's a benefit to the economy because you have more people working now. You're starting from a worse spot versus the U.S. We're actually at 5.6 if you updated this through December, and we don't have as much improvement to do as Europe, and so that's another reason why we're favoring some of the international. It's not very fun to be an international right now and deal with not as stellar returns, well, actually losses for 2014 in those areas, but at some point those areas will perform, and currently right now we're earning 33% more in a dividend in some of our international holdings than we are in our domestic holdings, not to mention that they're more attractively priced. So touch on this fiscal drag here. This just shows that when Europe decided they were going to do austerity, if you look at the Eurozone, there was from 2010 to 2013, there was about a 3.5% GDP reduction because of the structural deficits. And now you can see that is going to go from 3.5 to only 0.5. So that decrease in a headwind is going to help the Eurozone forward. Valuation, talked about this a lot already. This is just showing it in a little bit different way. This takes these four valuation metrics and it tries to put them into one composite, and it shows in history what that's looked like. So you can see developed developed international is just slightly above average versus the United States is significantly above average when you look at these four valuation metrics. And so, that would say that developed international is more attractively priced than the United States. It doesn't mean that you're going to have better returns internationally tomorrow or over the next year. It just means that compared to history, we got a little bit better valuation in developed international versus the U.S. And then we can break it down into each of the countries. And if you look at emerging markets, it's even more attractive. You've got emerging markets and they're under their long-term average composite level. So that is why we are very bullish on some of the asset classes that are outside of the United States. One of the things I wanted to point out here, this is a chart that I always show. It shows corporate profits here, and we don't want anybody to get alarmed here, but we look at Standard & Poor's preliminary estimate for fourth quarter, and some of these companies have recently reported, so we have an idea. But we're going to have a pretty significant drop-off in earnings because of energy companies. Now, that might be a real quick drop here because the energy companies are getting impacted very quickly with the energy price changing. But what we're not going to see is the car companies doing a little bit better because people are more willing to go buy a pickup truck here in the U.S. Those longer-term changes that consumers start to make different decisions because oil prices or gasoline prices are lower, those take a little bit more time to fluctuate to filter through the system versus the energy companies that hit right away on their earnings. And so you're going to see a little bit of a disconnect there. But we think in entirety, the drop in oil prices is actually positive for the global economy. There's definitely when you have oil prices drop 50% in a 6-month period of time, there's going to be some adjustments that need to be made, and they're going to be painful right away. And that's kind of what we're seeing. Some of these commodity prices and some of these energy companies around the world are going through that adjustment. But there's also a huge positive for every single person who consumes energy. So that will start to filter through the system. It's just going to take a little bit longer. Leverage is still at a very low level. So companies are not getting, they're not getting aggressive to the point where they're increasing their leverage to increase their earnings. And that is still a positive sign. When we start to see that go up, then we could get a little bit more concerned, because now companies are reaching a little bit to eke out that little bit more of earnings growth. Long term, this is just kind of put things in perspective here. In the 2000s, 1.8% of our return came from dividends, negative 2.7%. So we actually had a detraction from returns because of capital depreciation. But over the long run, you get about half your return from dividends, and you get half your return, a little more than half your return from capital appreciation. This is just, we just want to point out that in the current environment with low interest rates, it's going to be a lot more difficult to build a portfolio, whether it's an all-stock portfolio, whether it's a 50-50, 50% aggressive, 50% safe, whether it's even more conservative than that. It's going to be harder to earn those high rates of return that we're used to over longer periods of time, because you're starting with a risk-free rate that is ridiculously low. And so when you start with a risk-free rate that's low, each return, expected return from that point forward, when you take a little bit more risk, well, you're starting from a lower return point. And so you're just getting paid a little bit less for each of your expected risk outcomes. And we just want to make sure people are cognizant of that we're in a low interest rate environment that's going to have an impact on savers, which all of our clients are savers. We manage money, so pension funds, they're having a difficult time hitting the investment marks that they have. It just is a difficult time right now. When interest rates go back up, stocks may do well, and we'll get a little bit better returns in a little bit different environment. But we just want to make sure that people have the right expectations for the current environment. And then we see some equity dividend yields. Dividend yields are much better outside the United States for the most part than inside the United States. Same with REIT yields. And so, that's even more emphasis toward looking at assets that are abroad. We didn't think that a 6-month CD could get much worse, but it did. 2014, you can see we earned $130 on a $100,000 6-month CD. And not only that, but we're not getting paid to put $100,000 into a 6-month CD, but everybody wants to do it. We have a ton of cash on the sidelines. This number here represents, gives us an idea of how much cash is on the sidelines, and you can see we have a lot of cash on the sidelines still, and it's earning nothing. So there's still a lot of room for some of this cash to go into other areas. Maybe it goes into some fixed income. Maybe it goes into some safer stocks. Maybe it goes into some international stocks. Who knows? But this just goes to that previous slide of we're in a low interest rate environment. There's a lot of people who are just happy earning a very, very low interest rate on their cash. And that brings us to fund flows, and at some point that cash will have to do something. And you can start to see that since 2013, really, there's been an inflow into stocks. Well, go figure. Stocks have done pretty well, and so you have more people piling into stocks than you have into bonds, because bonds haven't done as well. But you still have people going into bonds. But since 2013, bonds have been, let's say, flat, and stocks are up a bunch. And so we think that trend will continue unless we see an interruption in stocks, which we're not, we want to be cautious, because we're going to have, there's always going to be a 10% pullback, 10% plus pullback that's lurking somewhere. So you always want to be cautious, especially when you're not necessarily getting paid a lot to take a lot of risk. But we don't see any imminent danger either. And so, 6-7% returns from stocks, that seems appropriate in this type of an environment. Now, 10 or 12% return from stocks in this environment, probably going to be a little bit more difficult, just where interest rates are. PE ratios and equity returns, just another reason here, and I've talked about this in the past, but there's a lot of new folks here on the call, so I'll go through this a little bit in more detail. If we look at PE ratios and we say, okay, well, the PE ratio is 10. If you give me 1 year, who knows what the stock market will do over 1 year when the PE ratio is 10. But if you give 5 years from when the PE multiple is 10, you can see that 10 and less, you get pretty dang good returns over 5 years if the PE multiple is less than 10 or less. If we start getting above 15 where we are now, over 1 year, I still can't tell you what we're going to do. It's all over the place. PE multiples are not good 1 year predictors. This is all that this chart is showing us. There's no rhyme or reason. But 5 year annualized periods, PE ratios give us some insight on what the next 5 years is going to be like. And so once you get above 15, you can see there's a line right here at, let's say, 16, 17. There's not a lot of instances where we've had PE multiples above 17. You can count, I mean, they're compared to less than 17, there's a lot less. So, and then a lot of them are not great returns. And so that is one of the reasons that we're just a little bit cautious here. We're not trying to scare anyone, but we definitely don't want to be jumping in with 2 feet. I always end with these diversification and the average investor. I think 2014, this really hits home because a portfolio like this may have done better in 2014. But if you look over the last, in this scenario here, you look over the last 20 years, you've got a return that is about equal. So this is a less diversified portfolio. It's got 3 asset classes. S&P, a big chunk of S&P, a small chunk of international, and a fairly medium-sized chunk of U.S. bonds. And your return has been 8.02% over this 20-year period of time. If we break that up and we have commodities, and we have REITs, and we have market neutral, and we have the S&P, but at a smaller percentage, we have small cap, international, emerging markets, and then some bonds, we can actually keep the same return, or 7.95, 8.02, you're splitting hairs there. But if you look at the risk, which is measured by standard deviation, you're taking 10.6 versus 9.7. That's a 10% reduction in risk without giving up very much on the return side. And so that's why diversification is so important over long periods of time, especially when you combine it with rebalancing and using dividends to buy things that are not doing as well. You start to put all that together, and you start to see why diversification makes sense. Now, in 2014, hey, being in the S&P 500 100%, that would have done the trick. But you can't guess what the next year is going to be. And when people start to try and guess, is usually when they start to get themselves into trouble and they start to chase returns, which is this next slide. And it's what does the average investor get, and why do they get that? Well, the average investor, this study is done by Dalbar over the last 20 years. The average investor has earned 2.5% in this study. When if they would have just bought and held the S&P 500, they would have made 9.2. So what's the disconnect between this 2.5 and this 9.2? It has everything to do with the average investor and their emotions and their time in the market. The average holding period is very short for the average investor, and when they go through turbulent times, they sometimes make bad decisions, and that's why they end up with a much lower return than if they would have just bought the index and held it. And I wouldn't even say that that's a prudent investment strategy just to buy the S&P, because if we added some of these other indexes and made a diversified portfolio, we could actually reduce the risk without giving up a lot of the upside return. Time frame. This is another one that a lot of people have a hard time with. This is showing a 1-year period of time from 1950 to 2014. If I owned stocks for 1 year, my outcomes would be between, I had the best outcome over this time frame for 1 year, up 51%. Wow, that's a great year. I wish I was invested in stocks that year. My worst 1-year performance over this time frame, negative 37%. So we're talking almost a 90% distribution. That's huge. I can't tell you where you're going to be, is basically what that's saying. If you're investing in the stock market for a 1-year time frame, you're pretty much rolling the dice. In fact, if you look at bonds, you're still, your worst case scenario is negative 8%. If you're looking at a 50-50 portfolio, you're between 32 and negative 15. 1-year time frames should not be invested in bonds, should not be invested in stocks. Really, 1-year time frame should be invested in cash and cash-like securities. When we have a longer than 1-year time frame, now we can start to expect to get a higher rate of return and have a lower distribution of returns, of annualized returns, the longer we give our money to grow, because we can outlive those fluctuations in the market. So 5 years, stock returns have been negative 2 annualized to positive 28. Bonds, negative 2 to positive 23. A 50-50 portfolio, one of the great things about this time frame here, 65 years, 5-year rolling period. If you had a 50-50 portfolio, 50% stocks, 50% bonds, you would not have lost money over 5 years. The worst time is a 1% return. And if you put that out to 10 years, you're even better, and your distributions go less. And then 20 years, now stocks make a lot of sense for 20 years. And now your worst case has been 6, your best case has been 18. We're putting the odds in our favor. One of the last slides here I'd like to let everybody think about, and I feel like I've been pretty negative on this call, so I want to make sure that I'm not swaying anybody to thinking that we're super negative. We're just cautious. When you have 3 years in a row that are negative 10, negative 6, negative 7, where your biggest pullbacks intra-year, when the average is 14.2, we've had 3 years where we haven't even gotten to the average yet. And so far in 2015, granted it's only 1 month in, we had a negative 3% January. So that's a long time frame to not have a 10% correction. Now, we've had 10% corrections in the international markets, in the emerging markets, but we have not seen that in the domestic market. So eventually, as my business partner Ryan would tell everybody, we will see a 10% correction. We just don't know when. And so we want to make sure that we're prepared for that, and that we have the right time frame, and that we have the right portfolio for our particular goals. So with that, I'm going to end with our investment implications here. As you can probably guess, we like commodities. 4 years in a row, the worst performing asset class of the ones that we track. That's one of the areas that we like. Market neutral is another area that we like. It gives us some safety without necessarily the interest rate risk of fixed income. emerging market equities, as I'm sure everybody can tell based on this conference, and developed international. Those are the asset classes that we like. Things that we're not too fond of: fixed income with long duration, domestic equities. It's not that we don't like domestic equities at these levels. We prefer equities over fixed income for sure, but we prefer international over domestic. REITs have been on a pretty good tear recently with interest rates coming down. REITs are more attractive. Same with utilities. So we'd just be a little bit more cautious on those two areas as well. So with that, I'm going to go ahead and open it up to questions that Nick will go ahead and ask those, and I'll do my best to answer them as thoroughly as I can.
Thank you, Steve, and everybody. At this time, we'll open up the webinar to questions. Of course, feel free to type any questions that you may have or comments in your webinar chat box, and we'll give everybody some time to gather that information, and then Sean will be glad to field any of those questions.
I'd also like to take this time to let everybody know that this has been a record attendance for our webinar. Thank you for participating. I'm glad to see it was a record.
Okay, Sean, do you want to offer any concluding remarks, or should we just extend the invitation for the second quarter webinar?
We've got one question, Nick. I can see it. The question is, what is an example of a market-neutral investment? That's a great question, and one that I'll spend a little bit of time here. So market neutral, the definition of market neutral, meaning we don't want any market risk. So we are going to, the strategy there is that an active manager has some sort of strategy that they want to take advantage of in the market. Let's say they have a really good black box that tells them when companies are overvalued versus when companies are undervalued. Now, a long-only manager can only buy stocks. They cannot short stocks. When you short a stock, you're selling it short, and you actually make money when that stock does poorly. So it's almost like a reverse bet of buying the stock. You're selling it, and you don't own it. You actually have to buy it back later at a higher price, possibly at a lower price, and then give it back to your broker that you borrowed it from. So that's what shorting a stock is. And so market neutral, we're trying to take all of the market risk. So when we say the market, and let's say we're talking about the S&P 500 market, let's say we're talking about a domestic market neutral strategy. We're looking at taking all of the S&P 500 risk out of this strategy. So we only want to be left with the manager's skill as our risk. And so a market neutral strategy would be, okay, let's look at the auto industry. And let's say the active manager does all of their analysis, and they say, you know what, GM is very attractively priced, it's undervalued, and Ford right now is very overvalued. And they do all their analysis, and that's what they come up with. So if that's the case, they think that Ford is overvalued, they think GM is undervalued, they're going to buy GM, and they're going to short Ford in the same exact amount of principal. And what you're left with is hopefully you've offset auto risk, you've offset market risk because you have one that's going up and one that's going down. You either make money or lose money on the differential between the two. So in that strategy, let's say the manager was correct and GM did better than Ford relative. So let's say GM was up 10% in the year and Ford was only up 5% for the year. If you take that entire position, you're going to actually see that the manager would have made 5% because they made 10 in GM and they lost 5 with Ford going up 5. But there's no correlation between their return and what the S&P 500 did during the year, because they're offsetting those risks because they own one and they short sold the other. So you're getting a beta of 0, and I'm probably talking CFA language now when I bring up beta, but beta is just a risk measure. A beta of 1 means you're taking the same amount of risk as the market, but a beta of 0 means you're market neutral. It doesn't matter what the market does. It has no bearing on your investment strategy. So that is, in a very generic way, what a market neutral strategy is. There are plenty of market neutral strategies. You don't just have to buy GM and sell Ford, or vice versa. You could, one of our funds is merger arbitrage fund. So they have a black box that says, okay, we think we know when public mergers and acquisitions are announced, we think we know, we think we have a better idea than the market on if those deals are actually going to close or not. And so the stocks will move right away when the announcement is made, and there's still some risk that the deal doesn't go through. And so they say, okay, well, we think the deal is going to go through, so we're going to buy the acquirer and we're going to sell the acquired, or vice versa, depending on if they think the deal is going to go through or not. But it doesn't. The market performance has nothing to do on the strategy. It's the assets that they're hedging together that has everything to do with that. So hopefully I answered that question that made sense.
Thanks, Dean. We've got another question here that I'll share with everyone. What is Ironwood's position on oil right now, and how do you see this commodity performing through the rest of 2015?
That's a very timely question. I was doing a presentation in October to a group of insurance actuaries, and oil was already in its drop, and I think it was around $70 a barrel. And I got asked a very similar question, and I said, oil at $75 a barrel makes a lot of sense because the world has a lot of oil, but the world doesn't have a lot of cheap oil. And so the U.S. cost for production is about $75 a barrel. Saudi's cost is about $10 a barrel. I would never have predicted oil to go down to $50 a barrel. So I believe the true price is more realistic, is more like $75 a barrel. When and how we get there, it's very difficult to tell right now. When you see oil going up and down 7, 8, 6%, either up or down on a day-to-day basis, there's a lot of people trying to answer that same question. But I think long run, oil goes higher than $50 a barrel. I think it probably goes up sooner rather than later, and I look to $75 a barrel as a medium-term target, let's say a year, 2 years out.
Thanks, Dean. I think we've fielded all the questions, so we can begin our concluding remarks.
Perfect. Well, we just want to thank everybody for attending the webinar tonight. Thank you for making this a record attendance. I really appreciate that. We really appreciate that. Ironwood does. We look forward to our next webinar, which will be promptly the first Thursday of May. I'm not exactly sure which day it is. Nick, do you have that? Do you have that date?
Momentarily here. The first Thursday in May is going to be May 7th, tentatively.
Okay. So looks like the next webinar, actually, you know what? We're doing it a little earlier. We're actually doing the next webinar in April. So Rebecca will send out an invitation. Look for that somewhere after April 1st. And until then, I'm sure we'll see most of you in reviews. But until then, have a great night, and we'll talk soon.